This is level 2 of the CFA program, the topic on corporate issuers and the reading on capital structure. Capital structure, of course, is the right-hand side of the balance sheet. We know that businesses invest in positive net present value projects, right? Those are the long-term assets, the property, plant, and equipment, the product lines that are over on the bottom left-hand side of the balance sheet. So let's take an example and suppose a company has uncovered a positive net present value project in the amount of, let's just say, $100. The question then becomes, is that net present value impacted by the choice of financing over on the right-hand side of the balance sheet? In other words, will a bond issue, will an equity issue increase or decrease the net present value of that particular product line? And you'll see that theme going through these learning outcome statements. We're going to start with, one of my favorite topics of all time. Franco Modigliani and Merton Miller, 1958, wrote the seminal paper on corporation finance. So we'll talk about leverage and taxes and financial distress and a bunch of other things, which is going to lead us to what we call a target capital structure and perhaps even an optimal capital structure. We'll go ahead and end with some international differences and some debt ratings. This is what you ought to remember from your undergraduate finance class and, of course, your studies of level 1. There we go. I just said to you, capital structure, that's the right-hand side of the balance sheet. So more formally, a mix of debt and equity that a company uses to finance its, and instead of using the word there, operations, which comes right out of the reading, how about if I say to finance its investment in positive net present value projects? Let's see, what do we know about goals of a business? Of course, primary goal, perhaps even the only goal, should be to maximize shareholder wealth. So if we're looking at the right-hand side of the balance sheet, we want to choose a capital structure. We want to choose a mix of debt and equity that's going to maximize the value of the firm. And mathematically, that's probably going to result in a decision that minimizes the weighted average cost of capital. And there's a good old formula for the weighted average cost of capital. When I teach this to my students, I call it the weighted average borrowing cost. A lot of textbooks and a lot of good professors, and me included, call it the hurdle rate. So no matter what you call it, the reading uses weighted average cost of capital, but you should be familiar with those other terms. And it really is just a weighted average. I want you to look inside of that equation under the R sub E, which is the marginal cost of equity, and the R sub D, which is the before tax marginal cost of debt. So think about the right-hand side of the balance sheet. What do executives and financial managers do? They pick up the phone and they call the bondholders and say, can you lend us a bunch of money? Bondholders say, yes, we're going to charge you 10%. Then they pick up the phone and call the shareholders and say, hey, can you lend us a bunch of money? Shareholders say, yes, we're going to charge you 20%. And so the weighted average cost of capital is a weighted average of the 10 and the 20%. And then, of course, it has to be adjusted by the laws of Congress, which allow interest payments to show up on the income statement and be an appropriate deduction. So there's a tax subsidy there, while not allowing dividend payments to show up on the income statement. So there's a built-in preference for debt in the tax code, at least in the United States, but it's similar throughout the countries of the world. But that tax advantage sometimes goes away, and sometimes it's less pronounced than it is in the United States. All right, capital structure decisions. So what we're going to do is we're going to go ahead and start with M&M all the way back in 1958, and what M&M taught us in their paper called The Cost of Capital, Corporation Finance, and the Theory of Investment. They taught us that in a highly restricted world, I always refer to this as the M&M world. I always compare it to kind of like a fantasy world. You remember on that one Seinfeld episode where Kramer Kramer went to the Yankee fantasy baseball camp. I kind of think of it that way. This M&M world is kind of a fantasy world, but it's not really a comedic world like on Seinfeld, but it's a world that teaches us lots and lots of really good things. And I'll emphasize that as we move through this slide deck. But what M&M taught us back in 1958 is that the value of a company, the market value of a company, is based on two factors. The quality of the assets, in other words, the ability of the assets to generate stable and branded cash flows, plus the weighted average cost of capital. And what M&M taught us in 1958 in their highly restricted fantasy world is that the capital structure decision does not impact value. And I'll show you all those assumptions here in just a few minutes. But then the cool thing about M&M is that they have this highly restrictive world, and then they start peeling some layers of those assumptions off. And they say something like, hey, what if there's taxes? What if there's financial distress costs or bankruptcy costs? What if there are agency costs? What if there are costs of differences in information sets? And what that does then, it adds value at each step so that we as good financial analysts can reasonably come up with a value of the firm. So we start with the basic M&M world, and then we relax assumptions to approach the reality of what we're facing in today's stock and bond markets. Now, when M&M first presented this paper at conferences, they were slightly criticized because people said, this is a fantasy world. There are things like taxes. There are things like financial distress. But M&M, they were pretty smart, and they said something like, look, we're showing everybody out there that to value a firm, you should focus on its ability to generate cash flows and the cost of borrowing. All this other stuff, taxes, financial distress, they're important, but they're only important if you can understand how to fundamentally value a company. All right, let's look at these M&M propositions here. So proposition one, they assume that there's no taxes. And this is called the capital structure irrelevance proposition. All right, so notice what we have written there. The market value of a company is not affected by the capital structure of the firm. So there's the value of the firm. The value of a levered firm is equal to the value of an unlevered firm. So once again, it doesn't matter whether there's a little bit of debt or lots of debt in capital structure. And what does the value depend on? Two things. Look in the numerator, EBIT. Now, this is what M&M had to deal with in 1958. There's a history of accounting, but there's not any history of finance. And of course, there's no history of in-depth investment analysis that you and I have been working on over the past years. So what I tell students is that look at this EBIT. That's just operating income. That's what M&M taught us in 1958, but you could easily substitute in there operating cash flow in the numerator. So what is the value of the company? The value depends on the ability of that company to generate cash flows. And then you divide by the weighted average cost of capital. Notice that this is just a present value of a perpetuity because M&M, in one of their assumptions in their fantasy world, they assumed that the firm was a no-growth firm. So it was going to have a fixed or a constant operating income. Boy, can I parenthetically say operating cash flows over an infinite time period. So the present value, that's super easy. You just take the operating income divided by the weighted average cost of capital, 10% or 15%, whatever it is. Now I'm going to show you how this holds true in the M&M world in just a second. But notice what we have in this slide at the bottom. Here are the following assumptions. So here's this M&M world, this M&M fantasy world, perfect capital markets, which means there are no transaction costs, there are no taxes, there are no bankruptcy costs. We have mentioned this assumption about information asymmetry. M&M assumed that there was no such thing. So they assumed homogeneous expectations, which simply means that you and we could show up on the floor of the New York Stock Exchange, and I may live in the United States and you may live in Iceland, and we arrive there and we've done our research on a particular company and we have the same thought process, all right? We've processed the information the same way, we've arrived at the same conclusions, so that's what homogeneous expectations means. Here's another assumption there, that anybody, including you and me and the federal government, can borrow at the risk-free rate of interest. There are no agency conflicts between the shareholders and the managers. There are no agency conflicts between the shareholders and the bondholders. There is just a perfect goal of maximizing shareholder wealth. There are no individuals interested in self-interest, et cetera, et cetera. So look at that last teardrop point on the right. Operating income is unaffected by the capital structure. All right, so what is the big implication here? If two firms have the same cash flow, then their values are going to be the same, regardless if one firm is highly leveraged and one firm has hardly any leverage. Now, of course, we need to ask ourselves the question, why is this true? And if there are no taxes, then there are no subsidies for preferences of debt over equity, or vice versa if the tax code allowed that. So there's no benefit to borrowing because there is no interest deductibility, which means then that the executives and the financial managers, they don't really care. They would say, sure, I can issue a bond. Sure, I can issue shares of stock. It's not going to impact the value because, and this is worth repeating, my students get tired of hearing me say this, but it's so important. Look at that equation. The value of a company is based on two factors: its ability to generate sustainable cash flow and its weighted average cost of capital. All right, I promise I'll only say that 100 more times during this video. Now, the other reasoning here is that there's nothing really special about a company issuing a bond, right? So a company could issue a bond and then invest in a positive net present value project. Or we could show up at the annual meeting and say, hey, we prefer that you issue shares of stock and invest in that same positive net present value project, because what we can do as shareholders, we can go to the bank and we can borrow money, personal leverage, and then I can go to the New York Stock Exchange and I can buy those shares. So M&M were among the first to suggest that there's nothing really interesting about corporate debt versus personal debt. In fact, they're perfect substitutes for each other. Now let's go ahead and focus on this idea of cost of capital and the cost of equity. Let's go ahead and read that quote there. Cost of equity is a linear function of the company's debt equity ratio. All right, so that makes sense, right? So look at the equation there in the middle of the slide. We have that cost of equity on the left, and that's equal to the cost of capital if there is no debt financing there, right? And then there's a plus sign. And then notice to the right of the bolded red, there's the debt equity ratio. And so there's some kind of risk premium that's attached into that difference. So the cost of equity increases linearly as the company increases its use of debt. However, there are consequences to that in the M&M world. And what we'll see here in just a few minutes is that the weighted average cost of capital remains constant over that debt to equity range. Let me show you what that means here. Are you ready for this? Look in the green equation that I have in the middle. So this is just weighted average cost of capital. Of course, there are no taxes there. And we're assuming that the cost of debt is less than the cost of equity. Of course, I mean, think about this. I'm the executive and I pick up the phone and I call half of you, and half of you are my bondholders. And I say, hey, I have this idea for a new positive NPV project. Send me a bunch of money. And if you guys agree to that, you'll say something like, hey, Jim, we'll charge you 5%. And that 5% is going to be based on the simple fact that I make you an explicit promise. I say, I will pay you interest and I will return your principal over 5 years or 10 years or 20 years. So I make a fixed promise to you. In addition, that fixed promise is backed by the assets of that positive net present value project. Then I borrowed half from you, so I have to pick up the phone and call the shareholders, and I'll say, hey, Mr. and Mrs. Shareholder, send me a bunch of money. And if they agree, they say, yes, Jim, here's your money. We're going to charge you 12%. And the reason that 12% is higher than the 5% is because I don't make an explicit promise to the shareholders. In fact, I make a vague promise. I say something to the shareholders. I say, look, I'm going to do my best to act as a good steward of your capital. And I'm going to try to invest in positive net present value projects. But these positive net present value projects are risky. They may or may not pay off. Therefore, my promise to you is, hey, if we're successful over here, I might pay you a dividend, but I don't have to. And if I don't pay you a dividend, you can stomp your feet and hold your breath for as long as you want, but you're not going to get a dividend out of me because I'm not legally obligated to do so. The other part of that vague promise is that I say to you, hey, look, even if I don't pay you a dividend, you might be able to go to the floor of the New York Stock Exchange and buy low and sell high, generating a capital gain. But those dividend promises and those capital gain promises depend on, boy, what did M&M just teach us? The quality of the asset, the ability of this asset to generate enough cash flow so that I can pay you interest, Mr. and Mrs. Bondholder, and I can pay you dividends and capital gains, Mr. and Mrs. Shareholder. So, of course, cost of debt is going to be less than the cost of equity. So there's just a simple weighted average green equation. And so this is what I've done at the bottom here. Here's an example. Let's suppose that we have $50 worth of bonds outstanding, $50 worth of common stock outstanding. So there's our quick equation to compute a 15%. Half of 10, right, and half of 20 gives me 15%. But then here's the cool thing about M&M World. You ready? Let's suppose that the executives of this company decide to issue a bond in the amount of $25. And instead of investing in a positive net present value project, they're going to take this 25 and go to the floor of the New York Stock Exchange and repurchase a bunch of shares. You see the difference in the weighted average. So now instead of 50 over 100, we have 75 over 100 because we've issued the new bond. We've repurchased the shares of stock. So instead of 50 over 100, we now have 25 over 100. So you see, of course, capital structure has changed. Now, what did we learn in that previous slide about the linear relationship? So I want you to think about this, right? You guys are my bondholders at 10%. But now I'm going to issue a bond in $25, so I have to go over there to new bondholders. And I say to these new bondholders, hey, lend me 25, I'm going to do something with it. And those bondholders, those new bondholders, they're going to look at you guys and they're going to say, wait a minute, they're charging 10%. Jim is expanding leverage, so there's extra risk. We're going to charge more. 10% is not enough because this has to be reflective of new market conditions and new capital structure. So I have to pay these new bondholders more. I picked 12% in this example. Then the shareholders, they say, wait a minute. The shareholders are running around saying, wait a minute, we used to have an ownership position in half of the company. Now we only have 25% position in the company, right? These existing shareholders that did not sell their shares. So now they're saying, wait a minute, there used to be 50, let me use this analogy, there used to be 50 bondholders in line to get paid before we potentially got our dividend payment. Now there are 75 people in line to get interest payments before we get our dividend payment. Oh my goodness gracious, we have to increase our marginal cost of equity. So I picked 24% there, right? So everybody agree that with this increase in leverage, we're increasing risk. So the yield to maturity on the bonds goes from 10 to 12. The required return on equity goes from 20 to 24. So here's the M&M thing. The M&M thing here is what happens, notice I left it blank. What happens to the weighted average cost of capital after this increase in leverage? And so I do this all the time to my students. I say, look, we're increasing the yield to maturity on the bond, 10 to 12. We're increasing required return on equity, 20 to 24. doesn't the weighted average cost of capital have to increase? Maybe it's 17%, maybe it's 18%, maybe it's some number, but of course it's not. This is the beauty of the M&M propositions, is that the answer is, of course, it's 15%. And so on a previous slide, what did we say? The weighted average cost of capital is unaffected by changes in leverage. Therefore, the denominator in that equation here, let me go back just to remind you of this one here. The denominator in this equation does not change. And if in fact in the M&M world, this is a no growth firm, so the EBIT in the numerator doesn't change. And if the denominator doesn't change, well, then the value of the firm remains unaffected. This is the capital structure irrelevance proposition. And let me assure you that M&M did not win the Nobel Prize in economics because they just simply proved mathematically, like I just did, that 15% equals 15%. This is the result of some beautiful calculus. And I go back once a year and I reread this article and I work through the calculus, and it really is a thing of beauty. It's artwork. And it flows so beautifully. The math is gorgeous. And after I'm done reading this article, I am reinvigorated to become a much better professor and a much better husband and a much better father and a much better brother, etc., etc. How's that for giving a personal story about how M&M have changed my life? And then, of course, what M&M have decide that the value of the firm is equal to the value of the debt plus the value of the equity. And this is a great lesson that comes out of their restricted and fantasy world. So think about this. It's easy to criticize M&M and say, look, your world doesn't reflect reality, but in fact, it reflects lots and lots of reality because we're focused on quality of the assets. That's why we do fundamental analysis. That's why in the CFA program, there's lots of topics that say, here, let's help you with fundamental analysis. This all comes from M&M. Okay, let's take a deep breath. That was fun for me. I hope it was at least a little bit of fun for you guys. So let's go ahead and peel away one of these layers. Let's say, all right, everything in this fantasy world holds true, but now we can allow the government to come in and say, hey, there's a tax rate. So we have to pay taxes on our EBIT. So look at that bottom equation. Now the value of the unlevered firm is EBIT times 1 minus the tax rate, of course. But we're also allowing the interest to be deductible. Notice that we have written up there in most countries. So look at the middle section there. So value of the firm, value of the levered firm is equal to the value of the unlevered firm plus the total amount of debt times that marginal tax rate, which means the following, that an executive can increase the value of the firm just by issuing a bond. So think about how easy this is. If you were an executive and your compensation was tied to stock price and bond price, you could just wake up every day and say, hey, I'm going to issue a bond today. And it doesn't even matter what you do with that bond issue. The stock price goes up, bond price goes up, and you get a bonus. And you do the same thing the next day, you do the same thing the next day. Well, let's suppose that when you issue a bond, you start repurchasing shares of stock, just like I did in that previous example. Well, sooner or later, you're going to run out of shares of stock. And so look right underneath M&M Proposition 1 with taxes, value is maximized at 100% debt. Now, this can be shown using some calculus, and this is one of those crazy things in calculus that mathematicians call a corner solution. And so the value of the firm is maximized at 100% debt. That means that there are no firms that have any equity. That means the New York Stock Exchange goes away because there is no shares of stock that are outstanding because all of the executives have gobbled them up in trying to maximize firm value. Now, the one adjustment for Proposition 2, which is our equation for weighted average cost of capital and the cost of equity, is just to throw the 1 minus the tax rate in there. And you can prove that you can prove that since debt financing is cheaper than equity financing. What did I have in that earlier example? I had the 10 and the 20, right? So what's going to happen? We're going to continue to, why would we borrow at 20 when we can borrow at 10? And so we're going to continue to borrow at 10 and 10 and 10 until we have 100% debt. Now, of course, you should be scratching your heads and say, wait a minute, Jim, I know if I go to the bank and I borrow $50,000 to buy a new car, they're going to charge me an interest rate. And if I show up the next day and say, hey, I want another $50,000 to buy a car for my husband or wife, they may charge me the same interest rate that they did yesterday, but depending on my credit rating, maybe it'll be the same rate. But if I do this day after day to borrow money to buy for my son and then my daughter and then my aunt and my uncle and parents, sooner or later the bank is going to say, hey, Jim, we need to start charging you a higher interest rate. Well, that doesn't consider us at all in this Proposition 2 with taxes. Remember, we are still ignoring the threat of bankruptcy and even the cost of financial distress. So here's a good summary page. Go ahead and take a picture of this and memorize those equations. Let's do just a super quick example. We give you a couple of details going down the left-hand teardrop, $6,000 in operating income, 12% weighted average cost of capital, cost of debt 6, total debt $18,000, tax rate of 30. So let's calculate the value of the firm under Proposition 1 with taxes and the cost of equity Proposition 2 with taxes. And so there's just a quick old summary there. So value of the unlevered firm, we take the 6,000 times 1 minus the tax rate divided by 0.12. That gives us 35,000. But then the value of the levered company, we're going to add the tax rate times the total amount of debt of the 18. So that gets us up to, what does that say? $40,400. So let me just round to 40,000. So the value of the unlevered firm, $35,000. When we issue the bond, it increases our value by around $5,000. Now, how about the second part of this? All we're doing here is, kind of doing some simple algebra, substituting and moving things to the front and the back and the left and above the equal sign. So let's go ahead and start with computing the value of the equity. So we know we take the 40,400, which we just computed on that previous slide, minus the bond issue. That gives us 22,400 worth of equity. So we can compute that required return on equity, the cost of equity, just sub all those numbers in there and you get, what is that, 15.38%. And then what we can do is we can go ahead and use some of those numbers to compute the value of the equity based on that equation there in the middle, right? Value of the firm is equal to debt plus equity. So you do all that stuff and you get the $40,400. Of course, we were going to get that. Then we can go ahead and compute the weighted average cost of capital, throw some of those numbers in there using that equation, and we get 10.39%. Wow, that's less than the 12% from the equation. And so this is what we're doing. We're trying to maximize the value of the firm. So there it is, once again, $40,400. So this is a super cool, quick example mathematically to show, and this is a much more complete example than what I gave you. What did I say earlier? The 15% is equal to the 15%. This is a much more complete example that shows a little bit more of the results of the calculus of their paper. All right, so what did we do? We started out with the fantasy world, then we peeled off a layer of no taxes. Now let's peel off a layer that there are no financial distress or bankruptcy costs. All right, so let's take a look at two kinds of financial distress costs, direct and indirect. So direct costs, these are easy. Direct, actual cash expenses related to bankruptcy. I remember when I first learned this back in graduate school, my professor just looked at us and said, when you declare bankruptcy, you don't do it by yourself. You have to hire a bunch of lawyers. And so I've always just thought of, okay, lawyer fees and court fees, whatever those are direct costs. But the way more interesting component of this are the indirect costs. And this is the way I think about it. Let's suppose that you're an executive and your company is not in bankruptcy proceedings yet, and you're in the process of nearing those bankruptcy proceedings because you have private information and you know that your assets over here on the balance sheet, they stink. And when the next quarterly report comes out, everybody on the floor of the New York Stock Exchange is going to know not only that the assets stink, but that you stink or I stink because we made the decisions to buy those assets. So think about your thought process as you're going to work every day, knowing that there's this doom horizon, right? So you're totally stressed out. So you drive to work and you're gripping the steering wheel, and you get into your office and you go, rah, and you start yelling at everybody, all right? Just because you're so stressed out. So look at some of these examples. You're going to lose customers. You're going to lose suppliers on the supply chain. I mean, think about the supply chain over there. You're going to lose valuable employees. You're going to lose all sorts of stuff. These are indirect costs because that's never going to show up on the income statement. There's not going to be a line that says, the cost of Jim being stressed out during this particular quarter. I mean, it would be really hard to put a number on there, like maybe $1 million or $10 million. All right, look at the second arrow point down at the bottom. The expected cost of financial distress increasing as the relative cost of debt financing increases. So that makes sense, right? If I'm on my way to work and I think back, I say, oh my gosh, I used to pay my bondholder 6%, but now I have to pay him 14%. How am I possibly going to be able to do that? All right, reduces the value of the firm. But here's where we have this great classic microeconomics discussion. What did we just say about taxes? There's benefit to taxes. So there's a marginal benefit to issuing a bond. But now we're also imposing the marginal cost of issuing a bond, and that's the cost of financial distress. So here's the question. We've got good things about a bond issue, right? Tax subsidy. We have bad things about a bond issue, right? Financial distress cost. So let's go back to my college days. You guys weren't even born probably in 1982 when I discovered Pac-Man. So which one is bigger? Is the tax subsidy or the financial distress cost bigger? Which one is going to gobble them up? Oh, now we're talking about really cool real life scenarios that we can only get to if we understand the M&M fantasy world. All right. Before we complete this discussion, let's go ahead and address another part of this LOS, agency costs. So what do we know? We know that executives act in their own self-interest. However, we also know that they're hired by the board of directors to maximize the value of the firm, maximize shareholder wealth. But here's the classic example that I give about agency costs. And those of you who know anything about Dennis Kozlowski, go ahead and do a little bit of research of Tyco. Dennis went to jail because of the agency conflict. And so let's suppose I'm an executive and I borrow a lot of money, whether it's a bond issue or a stock issue, and I have this great positive net present value project in which to invest. But when I have all this capital in my pocket, I'm thinking to myself, you know what, Jim, you're a great chief financial officer. In fact, you might be the best CFO that ever lived. I deserve a bigger office. I deserve another administrative assistant. I deserve a country club membership. I deserve bonuses. I deserve all this stuff. So I start taking some of that capital away from the investment in positive net present value projects, and I make my life better. Of course, at the extreme, we call these an excess consumption of perks. All right, so look at the agency cost. Incremental costs that arise from conflicts of interest between the principal and the agent, between the shareholders and me as the executive. They increase the cost of equity and reduce the value of the firm. All right, so here we're faced with this decision to issue a bond or issue shares of stock, which the bondholders and the shareholders are perfectly happy to lend me that capital because they know I'm a good steward of their capital, and I'm going to invest in positive net present value projects. However, the bondholders and the shareholders, they're not stupid. They know that I'm going to be tempted. I'm going to be tempted to take some of that money and maximize my own personal wealth. All right. So look at that third circle point. Better corporate governance lowers the agency costs. So here's my great example. Here's your homework assignment. You ready for this? What I want you to do is I want you to type in Johnson & Johnson, and I want you to type in board of directors. And I want you to go look at a picture of these 12 or 13 individuals. And you will see that these 12 or 13 really talented men and women, they have tremendous skilled backgrounds. They have areas of expertise. And I want you to imagine I'm the executive and I have just approved for myself a limousine service and a helicopter service and a Learjet and a country club membership, and I'm just consuming these excess agency costs. So I come before this board, right? I want you to look at these board members, and I come and I say, all right, I'm doing all this stuff over here. And these men and women, they're going to say, all right, Jim, prove to us that you're benefiting the company. And I say, wait a minute, I have a country club membership because I bring clients and potential clients and people on the supply chain. I bring them in and we have a nice lobster dinner. Of course, I eat lobster. But at the end, when we're done, they say, hey, we love your company. Here, we want to buy all these product lines for you. And if I'm flying in the jet over here and I'm increasing the business, right? Well, then this board is going to say, okay, Jim, have a nice day. But if I'm going up to the country club every day and I'm drinking a 6-pack of Budweiser and I can't go back to work and perform my job, the board is going to fire me, right? Board of directors' job is to hire and fire executives. So these agency costs provide another layer in this whole capital structure discussion. So here we go. Types of agency costs. So we have to monitor associated with supervising management, right? So what do we monitor? Board of directors, of course. Look at that third circle point. Let me repeat this. Better corporate governance lowers the agency cost. Boy, don't we have a whole reading on corporate governance? Those are fascinating discussions on the board and the board's responsibility for things like compensation and replacement and all that kind of good stuff. So look at the bottom left. Strong corporate governance reduces these costs. Of course, we know that. How about bonding costs? Of course, we sign contracts, and so these contracts are not inexpensive, and clearly they're not free. So we go out of our way to sign these contracts to bond our executives to behave in a manner consistent with shareholder wealth maximization. Let me just give you a quick example. There might be something that says, hey, the executives cannot go out and repurchase shares of stock unless they make sure they pay the bondholders their coupon payments first, bonding costs. And then residual loss. Over here, the orange, I want you to think of this, what I just said a few moments ago. This is the consumption, the excess consumption of perks. There are losses despite all of the efforts over there under monitoring and bonding. This is where I want you to go look for the Dennis Kozlowski example. How about asymmetric information? We've touched on this in a couple of previous recordings, and I mentioned it a few moments ago. And of course, managers, they have access to private information that nobody else does. I mean, they know about the quality of the assets in the assets' ability to generate cash flows for the next quarter, for the next year, or the next 5 years. And so what might happen here, right? This might happen is that managers might prioritize their source of capital over on the right-hand side of the balance sheet to do I want to use the word conceal? I think the reading is exactly what the slide says, reveals the least amount of information. And so, the issue is that if the executives have high quality, positive information, they have an incentive to get that out. But if they have low quality, poor information, right? If I stink and I know my assets stink, I don't want anyone to know about it. So I may try to conceal that information. Now, what this means is that the capital structure decision can result in an increase in value. So let's go back to what we learned the very first day of our corporate finance back in level 1. What do we know? Goal of business is to maximize shareholder wealth. How do we do that? Well, what did Modigliani and Miller just tell us? It depends on the quality of the asset. So what does that mean? Make something for pennies, sell it for dollars. That means branding, and that means minimizing the weighted average cost of capital. Well, it's possible to do all of that even outside of this fantasy Modigliani-Miller world. And that's what we have written down here at the very bottom. So the value of a levered firm is equal to the value of the unlevered firm plus the tax deduction of a bond issue minus the costs of financial distress, of course, in present value terms. So here we go. You ready? What do firms do? They find projects that have lots of cash flows so that those projects are going to have positive NPVs. That's the primary wealth maximization decision. But then a secondary wealth maximization decision is to look on the right-hand side of the balance sheet and say, okay, if I issue a bond, am I going to increase or decrease value? If I issue shares of stock, am I going to increase or decrease value? So if you use that generalized equation at the bottom, you can see that firms will come up with an optimal capital structure. And notice there's a plus sign and a minus sign there. And this is nothing more than what I said a few moments ago. It's a trade-off between, now these are all in present value terms, a trade-off between the marginal benefit of issuing a bond and the marginal cost of issuing a bond. Now let's go through a couple of quick graphs here as interpretation. So look at this graph here. So debt equity ratio, so leverage on the horizontal axis and cost of capital on the vertical axis. And so look at the different colors there. So this is what we just said. Cost after tax cost of debt creeps up, right? Cost of equity creeps up. So the weighted average cost of capital mathematically is going to initially dip downward and then increase. So there's an optimal capital structure. There's an optimal weighted average cost of capital. Now that can be illustrated in this beautiful graph that's taken right out of the reading. So there's debt equity ratio again on the horizontal axis, and then there's market value of the firm. So look at the green. There's the value of the unlevered firm. That's the value of the unlevered firm equals the value of the levered firm in the M&M fantasy world. But then what happens? We start issuing a bond. And so the red goes up and up and up and up. But then as we move and increase our leverage, the present value of those financial distress costs becomes super large. And so think about it this way. In the very beginning, when a firm issues its first bond and second and third bond, the tax advantage of issuing a bond has the big old Pac-Man, and it's eating up the little present value of financial distress costs. But as we get further and further out to the right, the present value of the financial distress cost becomes bigger than the tax advantage of issuing a bond. That's why that red line, look at the red line there, it goes up and up and up, and then it starts curving down. So there's an optimal point. And this is simple, that the marginal cost of issuing a bond is equal to the marginal benefit of issuing a bond, and that results in an optimal debt equity ratio. So you ready for Jim's summary here? How do companies maximize the value of the firm? How do they maximize shareholder wealth? They find lots of positive net present value projects. They borrow from bondholders and shareholders at the lowest possible rate, and then they issue a bond to get the firm to that optimal debt equity ratio. All right, capital structure of the company should be considered. Oh, look at this LOS, right? Explain factors an analyst should consider. So here we are, we're financial analysts, and I would like this LOS to say something like, explain the factors that Modigliani-Miller taught us back in 1958 in their fantasy world that we can use today, right? Today, M&M are still extremely relevant. All right, capital structure is not something that executives are going to wake up and say, oh, my capital structure today is optimal debt equity 0.52, and tomorrow it might be 0.61. I mean, this is considered long-term, right? Goal of the business is to maximize shareholder wealth over the long term. So capital structure decisions are a major corporate decision, so they have to be considered over time. You can't be running around having heart attacks over spilt milk every day. Now, one of the cool things that I teach my students, especially at the graduate level, is that when we do our M&M chapters and I actually require them to write memos on issuing a bond, I have them go pick a competitor and take a look at the competitors' ratios and default ratings, and not just capital structure ratios, but all kinds of ratios. So of course we need to consider what industry in which we're operating, and we should have similar ratios and capital structures to our competitors. Other factors: industry, financial flexibility, information asymmetry. Here, let me say this again. I know I regularly repeat this in my recordings, but I have a colleague who's really big on scanning the environment. So when as an executive, we need to look internally, right? So look at our financial ratios, look at the quality of our asset, look at our weighted average cost of capital internally, but then we need to put our eyes and ears and all of our senses outward to scan the environment. And so those other factors typically relate to what's going on outside of our little bubble. Now, of course, financial leverage is not consistent across international settings, and nor should it be. So internally, capital structure should depend on company-specific factors like all the stuff that we just talked about, right? But then also they're going to differ based on regulation differences, tax policy differences, and country traditions. So here's a good slide to know. Differences in capital structure can be explained by institutional and legal environment. Of course, accounting standards and taxation. Of course, didn't we just go through a bunch of readings on financial reporting in which we had to worry about US GAAP and then the international standards as well? So it'd be nice if someday, at least from a financial analyst perspective, that every set of financial statements was crafted using the same standards. Of course, that probably will never happen. Characteristics of financial markets and then the macroeconomic environment. Yeah, those make perfect sense. So here's a good table. Take a picture of this to address this final LOS. Country-specific factors, use of debt, use of total debt, and then the maturity of debt. And so you can go through some of these factors that relate to structural or legal issues, and then financial market factors, and then macroeconomic factors. Boy, I hate to do this to you because I say this to my students, especially my graduate students, all the time, is that when you get to a question like this, and you're looking at differences between and among different kinds of countries, it doesn't hurt. I'm not saying you to do this, but it doesn't hurt to go back to your undergraduate days when you performed a SWOT analysis: strengths, weaknesses, opportunities, and threats. And if you think about SWOT, you might think that you should be able to answer this impact of country-specific factors on capital structure. Strengths and weaknesses. I mean, that's a pretty standard way to answer questions. And that takes us through these learning outcome statements. Of course, for my money, if I'm writing a question, I'm focusing on Modigliani-Miller, of course.